A turnover ratio measures a mutual fund's level of trading activity in a given time period, usually a year. Each fund's investment strategy and asset type affects the turnover ratio number, as do overall economic conditions. Thus, comparing one fund's high turnover ratio to another's low turnover ratio may not be appropriate if the first fund's investment objective is to actively trade stocks and the second fund's objective is to buy and hold. For any two funds that are similar, a low turnover ratio is preferable. In this case, a high ratio indicates additional brokerage fees, which reduce the fund's return. Also, the additional trading may generate short-term capital gains and thus create tax issues for fund shareholders. It's best to look at a fund's turnover ratio over a number of years to get an idea of what is normal for a given type of fund. The turnover ratio formula is the fund's total sales or total purchases for the period, whichever is greater, divided by average net investments for the period. ABC's net investments are $200 million in the beginning of the year and $325 million at the end of the year. Thus, its average net investments for the year is 200 plus 325 divided by 2 equals $262.5 million. If purchases are $75 million and sales are $85 million for the year, then the turnover ratio is calculated by dividing the greater number, 85 million, by the average net investments, $262.5 million. This equals a turnover ratio of 32.38%.